Have you always wanted to try investing but you didn't know where to start? If so, keep watching because today we're diving into the world of investing, tailored specifically for beginners. Whether you're looking to grow your savings, prepare for retirement, or you're just curious about how investing works, you're in the right place. Hi friends, welcome to my channel. I'm Eva and I'm here to teach you all about entrepreneurship, personal finance, and lifestyle improvements that you can make to help you live a better life. Before we dive deeper, let's address a fundamental question. Why should we even bother investing? The answer lies in understanding the concept of time value of money. So what is time value of money? Essentially, the value of money isn't static, it changes over time. To picture this, imagine you have $5 today. Due to inflation, the purchasing power of that $5 would decrease over time. So say today you can buy a coffee for $5. In 10 years' time, that coffee might cost $8. So that $5 you diligently put away into savings today will no longer be able to buy you that coffee in 10 years' time. Here is where investing comes into play. Instead of letting your money lose value over time, investing allows you to potentially increase the value. If you invest that $5 in an average annual return rate of say 7%, that $5 could turn into almost $10, which would be enough to buy you that cup of coffee and also have change. This strategy has the potential to outpace inflation and increase your purchasing power. By investing wisely, you are not just saving money, but you're working towards building a more secure future. So let's dive into what investing is. At its core, investing is just about putting your money to work for you. It's a strategy to increase your wealth over time by purchasing assets that you believe will grow in value. Unlike savings, which typically involves putting money into a bank account, investing aims to achieve higher returns. However, it's important to remember that with the potential for higher returns also comes higher risk. Before we keep learning about investing, it's crucial to understand the concept of risk. Risk is inherent in all investments, and it refers to the possibility of losing some or even all of your initial investment. Different types of investments come with different levels of risk and potential returns. Generally, high-risk investments offer the possibility of high returns. It's essential to assess your risk tolerance and financial goals when choosing where to invest. Remember, never invest money that you can't afford to lose. A way to reduce risk is through diversification. Diversification is a key investment strategy that involves spreading your investments across various asset classes, such as stocks, bonds, real estate, and cash, all within asset classes, like different sectors or geographic regions. The underlying principle of diversification is not to put all your eggs in one basket. By diversifying your portfolio, you reduce the risk that a single poor performing investment could significantly impact your overall portfolio. This is because different asset classes and sectors often react differently to economic events. For example, when one sector or asset class is experiencing a downturn, another might be performing really well, which can help to offset losses and stabilize your portfolio's performance over time. In essence, diversification helps to smooth out your investment returns, reducing the risk of a significant loss and providing a more stable growth path for your investments. Alright, so now that we've gone over what investing is, let's take a look at some different types of investments that you can make. For beginners, there are several accessible investment options to consider. Stocks or shares. Buying shares of a company makes you a part owner. Usually it's a very small part owner, depending on how many shares you buy. Shares have the potential for higher returns, but they also come with higher risk. It's important to look into the company's finances and determine if buying their shares is the right choice for you. This can be a little bit tricky if you're just starting out. Mutual funds or managed funds. This is pooling money with other investors to buy a diversified portfolio of stocks and/or bonds. Mutual funds are managed by professionals, making them a hands-off investment option. The level of risk and return here can vary depending on how the money is invested. Exchange traded funds or ETFs. These are similar to mutual funds but traded on the stock exchange like individual stocks. An ETF is basically a basket of shares of multiple companies which helps to offer diversification. They're generally more cost effective and are lower risk than individual shares. The returns here can vary, but depending on the ETF, it could return say 7 to 10% or even more annually. High interest savings accounts. This is a low-risk option provided by banks to help you grow your money. Here in Australia, ING, for example, offers a 5.5% interest rates on their savings accounts, which means that the money you keep in there will automatically increase by 5.5% each year. This is a low-risk strategy because even if the bank was to collapse, which is unlikely, the Australian government offers a guarantee of up to $250,000 of your money. Bonds. Bonds are a type of investment where you lend money to the government or a corporation in exchange for fixed interest payments. Bonds are generally considered safer than stocks, but they offer lower returns. Bonds typically offer higher interest rate than CDs, but the risks are also greater. CDs, or certificates of deposit, are a type of term deposit which are a low risk option provided by banks. However, the interest rates here are typically lower than other previously mentioned options. These type of term deposits lock your money into them for a set period of time, which could be anywhere from a few months to 30 years. Now, getting started with investing doesn't have to be complicated. Here are a few steps to help you begin. Set clear financial goals. Determine what you're investing for and your time horizon. This will help to guide your investment choices. So say you have $20,000 but you want to use that in 1 to 2 years time to buy a car or put towards a house deposit, then maybe a high interest savings account could be the better option for you. However, if you don't expect to need that money for another, say, 10 to 20 years, then investing in the stock market might make more sense. Start small. You don't need a lot of money to start investing. Many platforms allow you to start with small amounts. For example, in Australia, there's a company called Self-Wealth, which allows someone to start investing with just $500. In the US, that minimum amount can be a lot less. The key here is to get started and learn as you go. Educate yourself. Take advantage of online resources, books, and courses to help you understand the basics of investing. Start with easier investments rather than jumping straight into analyzing a company's financials to buy individual shares. Personally, I started with ETFs because it meant that I didn't need to deep dive into the financials and I could buy something that was well diversified already. Consider robo-advisors. For beginners, robo-advisors can be a great way to start investing. They automatically manage your investments based on your goals and risk tolerance. The downside here is that it's an algorithm making decisions for you, so it might not line up 100% to what you would have chosen if you did it yourself. An alternative to this would be to speak to a real financial advisor. However, depending on how much you want to invest, this might not actually make sense because their fees will be a lot greater than what you could potentially get on your return. Diversify your portfolio. As we said before, don't put all your eggs into one basket. Diversification can help to reduce risk by spreading your investments across multiple different assets. As a beginner, it's easy to make mistakes. Here are a few to avoid. Investing without a plan. Always have clear goals and a strategy in place. Following market trends blindly. Investing based on hype or fear can lead to poor decisions. Not diversifying. Diversification is key to managing risk effectively. If you put all your money into one company's shares and that company goes bankrupt, then you would have lost everything. However, if you only invested 1% of your money into that company, then you wouldn't feel the effects as much. Ignoring fees. Be aware of the fees associated with investing as they can eat into your returns over time. Now, before we wrap up, there's one more crucial concept that I want to introduce you to. That is dollar cost averaging. Dollar cost averaging is a strategy that can significantly benefit beginners in the investing world. It involves regularly investing a fixed amount of money into a particular asset or portfolio, regardless of the market's price. This could mean investing a set amount monthly, quarterly, or at any interval that works for you. The great thing about dollar cost averaging is its simplicity and its power to mitigate risk. By investing a fixed amount regularly, you buy shares regardless of the market fluctuations in price. Over time, this can average out your cost of investments and potentially reduce the impact of market volatility on your portfolio. It's a way to remove emotion out of the investing equation, avoiding the common pitfalls of trying to time the market. And with that, we've covered the essentials of investing for beginners. Thanks for watching. If you found this video helpful, please give it a thumbs up, subscribe for more content, and share with your friends who might also benefit from learning about investing. Happy investing and see you in the next video.